topic today. Of course, if you have questions, go ahead and post those. We'll answer them at the end of the webinar. So how fundable is your business? We've done a webinar that talks about this topic, but I wanted to graze over it because it's very applicable to what we're talking about today. So let's define what it means to be fundable. We want lenders to see your business as a safe risk, deserving of funds, able to repay, and the actual company or individual that's authorized to borrow on behalf of the company. Now, a lot of individuals forget about this element. The reason that is important is because there are a lot of companies out there that are fraudulently applying for financing. And so lenders are trying to prevent loss. And so they'll look at things like the public records, make sure that you're listed with the entity. They may ask for a copy of the driver's license and so forth. And that's what they're trying to do, is just verify that you're able to sign on behalf of the company and that you are who you say you are. What makes a business fundable? So we talk a lot about the 5 C's of lending: the character, capacity, collateral, capital, and conditions. So let's dive into them. Like I said, we're just going to graze over these today because they are applicable to our topic. The first is the character: who you and your business, who are you and your business? So they want to feel comfortable that your business exists and know what you're doing and so forth. Do you have corporate credibility, business and personal credit history, and so forth? Those are all items that make up the character of your business. Capacity: what is your ability to pay back the new debt? Debt to income ratio is something that creditors are looking at. Can this business pay back the debt that I'm giving them, essentially? I talked with many business owners today that they've used their personal credit to finance their business. That's very common because that's something we're comfortable with. We know how to get personal credit cards. We know how to get these personal financing options. And so a lot of business owners will go that route. It's very common. But what happens is we start to hurt our debt to income ratio and utilization. We want to make sure that we're applying with lenders that just report on the business credit or don't show on the personal credit report. We're protecting this capacity to pay back on the individual level and then keeping the business credit under the business. The source of income: is it stable? When we're doing a more fully underwritten deal, they're going to look at the stability of the income and the source. Let's see. The next one is collateral. So in many instances, collateral can offset the need for a perfect personal credit score. And when we think about collateral, we want to think like a lender. So that lender takes collateral. Well, let's say the loan goes south. How do they liquidate it, right? And so that's a factor that they look at when they're identifying whether they want to lend based on that collateral or not. So, for instance, something that has a title like a truck, a car, let's see, I'm trying to think, a huge moving vehicle, a truck or diesel, something like that, where there's an actual title that they can take a lien on. Those are easier to liquidate than, for instance, printers or software and those type of items. So that's not to say that there aren't lenders that will lend based on those items, but usually if it's higher risk or harder to liquidate, the cost of the financing goes up. So we're training our minds to think like a lender so we know what to expect. And I think that's half the battle, is understanding what the financing limitations are so that you can secure the best financing for your business. And that's why we're here, is to help you understand what the business can qualify for and what the best fit is. Capital, savings, investments, and other assets can be used to pay back the loan. What is the source of repayment? How is this business going to pay me back? And so forth. This is another factor that lenders look at. conditions. What are you going to use the money for? Environmental conditions, economic conditions, and industry conditions. Lenders are constantly identifying the risk in lending, and they offset the risk by reviewing the 5 C's that we just talked about. In the end, they ask themselves, is the business worth the risk, and will I get my money back? It's important, like I said, to think like a lender. Risk determines the terms. So, the length of financing, the interest rate, the fees, the repayment fees, the covenants, and so forth is a direct reflection of the risk. We're going to talk about some products that are out in the financing market that are higher risk, therefore, the cost is high. But those items that are lower risk, the cost of that type of financing decreases. There's a direct correlation there. Okay, so let's dive in to some of the financing products. And that's what I wanted to talk about today is some of these typical products that are out there. Okay, let's see if we can get this bigger. Apparently not. Okay, so first let's start with the unsecured credit lines and cards. These are items where these are the most desirable items. That's the most common item that most small business owners are looking for is a line of credit. I hear that quite a bit, or a business credit card or a loan. Now, this is a conventional form of financing. They can offer, $5,000 cards all the way up to $150,000 in general. These approvals typically will mimic the highest revolving credit limit that you have on your personal credit report. That means these lenders are looking at the personal credit report. They want to see that you're at least in the 670, 680 range, no negative items, no open collections, bankruptcies, low number of inquiries. They'll look at the revolving percentage. They want it to be no higher than 50% in most cases. They don't do a cumulative, they don't add up all the cards. That's per card that they want to see a 50% balance to credit limit. The financing cost on these type of products, the lines, the loans, the credit cards, is typically lower because they're looking at the personal guarantee, and that's a good form of verification of how the business is going to handle the debt. So rates from 5 to 29% are pretty average. These lenders, though, if we go with credit cards, often offer an introductory rate of 0% or 3.9. They also send out promotional balance transfer checks, or you can call in and ask for, what promotion do you have on balance transfers, and credit cards will offer that. Oftentimes, credit cards are cheaper financing than a line of credit. And I know in the past, a line of credit was what every business owner wanted, but credit cards have made themselves very desirable. And even though the interest rate on that card, the stated interest rate may be higher than a line because of the promotional offers, it can sometimes be the cheapest form of financing. So, something to keep in mind there. The next item on this list is the revenue financing. So the revenue financing, they are looking at the money flowing through a business checking account, okay? And they want to see that there are funds going in and out. They like to see merchant deposits. They like to see at least 20 transactions per month in general. And they do look at the personal credit, but they're not sensitive to the personal credit being perfect. So if you're in the 500 range, they'll still lend, and they're verifying typically 6 months bank statements to make them feel comfortable enough to lend. Now, of course, they are not taking collateral, nor is there any guarantee that you'll continue to process the same amount in payments with your merchant account, or have the same amount of revenue coming through your checking account. So this is a higher risk lending product. Now, that means that the rates and so forth are higher and the term is shorter. So this product usually anywhere from 10 to 45%, and the term is short, 3 to 18 months. Now, keep in mind, if the owner doesn't have great personal credit, there's no real collateral assets and so forth that we can use to get other financing options, this is sometimes the best option left. And this is a very effective type of financing because once you start to develop a relationship with this type of lender, they'll often give you better terms as you work with them. They'll increase the term and they'll lower the rate and even increase the amounts that they lend. After 2-3 months of good payment history, it's not uncommon for them to come back to my client and increase the loan amount and decrease that rate. So it's something, once my clients start using it, they continue to do so because it's the best option for financing in their circumstance. When a client uses this type of financing, I often suggest that they use those funds in a wise manner. So, for instance, if a doctor needed to buy an X-ray machine, this was the best option for financing. Then he could purchase that X-ray machine and triple his revenue. That obviously was a very good investment. So, business revenue financing definitely has its place where a lot of businesses out there can qualify for this product where they wouldn't qualify for others. Um, it's a great option. There are other types of financing that we'll also talk about. The accounts receivable financing and factoring. This is based on if you are collecting from other businesses. There are lenders that'll collect your ARs for you and they'll give you the money right away. So let's say that I am billing Walmart every month for $20,000. Well, this AR financing company will take on that project of collecting the receivable from Walmart and pay your money up front. And they do charge rates and fees to do that, but that way you're eliminating that lull between uh, giving them your product and collecting for the purchase. Merchant cash advance. So this is much like the revenue financing where it's a higher risk product, but it's easier to qualify for if you have revenue flowing through your merchant account. So if you're sliding a lot of cards, taking payments and so forth, this lender will lend. These lenders, there's multiple lenders out there that do this that we work with, they will lend based on the amounts that you are processing. They typically want 3 to 6 months bank statements, and the rates, because it's a higher risk item, 10 to 45%. Okay. And then the last item we're going to brush on today is the equipment lending. And uh, we dabbled in this a little bit today. We talked about that if the business has, for instance, a diesel that they want to purchase, there are lenders out there that will lend for that purchase. Typically, you may need to have a down payment if it's a larger purchase and so forth. But equipment financing is a great way to purchase equipment where a lender can take collateral and it decreases the risk. So the rates and terms are usually pretty affordable. Their credit requirements a 580 or higher FICO score. The rates are 5 to 21%. That's a huge range. And the variables that are included in that range are what type of equipment is the collateral, what's the personal credit like, what type of business is it, and so forth. Okay, so these are some of the general financing products. We also, in the market, there's also 401k financing and securities financing. If you have a 401k or a stable security, uh, there's lenders that'll lend based on the value of those items. And the rates are pretty low because the risk is lower in that type of a product. The FICO score requirements are quite low. And so if you do have either of those items, there are business financing options. Purchase order financing is much like the AR financing and inventory financing. Purchase order financing is, for instance, if Walmart ordered 20,000 t-shirts and you needed to get those t-shirts created and so forth, you need a loan to help you get the supplies and things to create those t-shirts and get them ready to send to Walmart before you actually get your money. So this lender will underwrite the purchase order, and if it's somebody that's trustworthy like Walmart and it looks like a good deal, they are willing to lend up to 95% of that purchase order. They do charge an interest rate, and there's no personal credit score requirements. Inventory is much like the accounts receivable. Um, and the business advisor can definitely talk to you about that. I want to make sure I don't miss any of these. And once again, what we're doing is we're talking about the common types of financing out there in the market. So this gives you a good idea of what is out there, these, so that you can look at the elements of fundability, the elements that make your business fundable, and discuss those with the advisor team so that we can really map out what the best financing options are for you. That's why we ask so many questions, is we're trying to understand all those elements that make your business fundable so that we can find the financing that's the best fit for your business. We do have rehab. There's some lenders out there that do rehab financing that will finance if you're rehabbing residential investment properties. It's a shorter term type of financing, up to 65% of the value, 8% to 18%, and it needs to be a 660 FICO score or higher. There's commercial real estate lenders, and they will typically do 55 to 65% loan to value. The interest rates are a little bit lower because there is collateral that's backing up the type of financing. There's signage financing. So if you need a sign for your business, there are lenders out there that will lend for that sign. A 620 FICO score or higher, 8 to 12%, and the term is shorter, 3 to 12 months. They'll give about $1,500 to $50,000 in general. If you want to be one of those cool cars driving around with a wrap and your business logo and so forth on it, there are lenders that'll lend to wrap your car in all of your marketing, and they do $1,500 to $15,000 and 3 to 12 months. So this is a general overview of the financing that is out there, and I quickly went through them because I just want you to have an idea of what is out there and to start thinking like a lender and looking at your business like a lender and identifying what those elements are that make your business fundable, so that the finance team and the advisor team can talk to you and create that financing blueprint that we talked about recently. Improving how fundable your business is, we want to stick to those 5 C's and improve in those areas if at all possible. Submit applications correctly, and that's what we're here to do, is make sure that your applications are submitted correctly, and understand your financing blueprint. Know what you qualify for right away, what you can do to qualify for more, and as your business changes, continually changing that financing blueprint. I think one of the best tools that a business can have is that blueprint, understanding what your business realistically qualifies for so you can make decisions according to that. With no question in your mind, is there a product I'm missing? Is there something that I could get that I'm not utilizing? That's what the financing blueprint can do for your business is that true understanding of what financing your business qualifies for. And as you know, the business finance team, advisor team is always here to help. And you can call us directly at 800-497-0499. Our email is advisor@businessfinancesuite.com. As you're working through the program, make sure as you complete step 1 that you go to step 2, answer those questions, and we can start to apply for any products that you qualify for right away during step 2. Don't make the mistake of working through 3, 4, and 5 in hopes to go for that immediate financing. We want to draw up that blueprint in step 2 so that while you build the business credit, we can work on any financing you qualify for right away. So we definitely work on the financing of your business in multiple stages so that you're utilizing whatever is available to you in the market. Let's go over any questions, if there are any. I have no questions today. Well, I'm glad you all joined me. I hope this brief overview of the general financing products in the lending market was helpful. I hope it helped you start thinking like a lender so that you can look at your business like a lender and discuss those elements that make your business fundable with the advisor team so we can draw up that financing blueprint. As always, you can reach out to us anytime you have questions, and we are grateful for the opportunity to work with you and your business to help you with all your financing needs and help you develop your business into something that you really want it to be. So it's a pleasure working with all of you. Have a wonderful day. Please join us next week. Check out the YouTube channel to review this webinar whenever is handy for you. Thank you.